Hello and welcome back to another Debt-Free Guys Live. John and I are here. This week we are excited to talk to you about investing. So remember, this is a series that John and I are working on to help you become better with your money. If you are looking for other items or other videos in this series, just remember to search the hashtag Debt-Free Guys Live. So this week we are going to be talking about 5 steps to start investing. It's encouraging to John and I the number of people that we have email us who say that they want to get ahead financially, that they want to make progress, and especially that they haven't started saving for retirement yet, but they want to start doing that. So that's why this week we are diving into this whole idea of getting started with investing. And what we've done is we've created a very simple, as we call it here, a super simple investing guide. If you click on the link above, you can download that investing guide. And so the whole idea of that investing guide is to be a tool that you can use to help you understand a little bit more, especially if you're a little hesitant to start investing. You know, John and I look back on our time when we first got out of debt, and we're so grateful that we started investing. That is what helped us go from basically having zero in our net worth to today having over $700,000 in net worth. And most of that has accumulated over the last 10 years because we started investing.
Yeah, it was so much more fun to watch our money grow than to watch our debt grow or to even watch our debt be paid down. It was fun to watch the debt go down, but it was much more fun to start watching our assets accumulate. And I'll say I think that regardless of whose party is in power, I think that everybody's goal in Washington, D.C. is to make sure that the stock market continues to go up. So whether you're a Democrat or a Republican, you can't go wrong with
or somewhere
investing.
in between. Right.
Yeah.
And you know, as we've said so many times before, our focus is to help build a strong queer community. We want our community to be strong so that we can tackle any challenge that faces us. And one of the important ways of doing that is being financially strong. And so that being an investor and making sure that you're keeping up and making progress financially is so important to helping our community. It's one of the reasons why so many in our community who have money can give back to help organizations continue to fight for equality for our community.
Exactly. It is impossible to become financially independent and especially to become wealthy today without investing in the stock market, without investing in real estate, without investing in anything.
Right.
It's imperative. So if you want to get on the road to financial freedom, one of your first goals should be is to pay off all your debt. The second goal should be then to save as much money and invest as much money as possible. Right. Because that's the road to financial wellness. But so I think it's interesting. We oftentimes get people who say, you know, who we talk about investing with, and they say, "Oh, I'm a little bit scared about investing." Right. But then they say the next question is, well, how do I get started? I've heard of this one stock I should check out.
Right.
Like I hear Apple's doing well. I should have all my stock in Apple.
Right.
Or I know when the Shock Jock radio DJ, it just slipped my mind, Howard Stern joined Sirius Satellite Radio. That morning, David and I was on the trade desk at the time. I don't know if you were on the trade desk yet. But that morning we got thousands and thousands and thousands of calls of people who all of a sudden wanted to buy their first investment, and it was going to be Sirius Satellite Radio because Howard Stern was going over to Sirius. And I thought, oh my gosh, the news is already broken. You've missed the opportunity to make a lot of money. So one of the things that we want to first caution is that when you get into investing is to make sure you don't get stuck in the idea of having that one stock that's going to help you get rich. Right. We've all heard the story of the one guy who invested in that one stock and he became a billionaire. But that is few and far between.
Exactly.
Yeah, most people don't get rich that way. Most people get rich by diversifying and investing in a number of assets, and not just in the stock market. Like I said, real estate. People also invest in art and collectibles and other things. And there's a lot of ways that you can diversify both within the stock market and outside of the stock market.
Right, and that whole picture there, that idea of diversifying, as we just showed here, we've all heard this saying, "Don't put all your eggs in one basket," and that really is what it's about. Is making sure that you have a lot of different ways and means in which you can grow yourself financially.
Exactly. That's why another reason why we recommend that people diversify their income streams, because you can't, especially in today's economy, rely solely on one income stream. But that's another topic.
Exactly.
The other thing that I think is interesting is people will oftentimes want to follow the trend. Sirius satellite radio was one of those at the time when Howard Stern joined. But right now we'll get people who are like, no, I can never invest in the stock market. And then the next time we hear them, have you heard about Bitcoin? Should I invest in Bitcoin? What's all this blockchain stuff going on? And they want to get involved in the hot stock or the hot item of the day. Bitcoin's fascinating right now, mostly because it's new and very few people understand it. But is it for the everyday investor like you and me? Probably not, at least not yet. There might be some ways that we can take advantage of it, but as a strategy to gain financial freedom, that's not really where you want to put your cash.
Right. Well, and as you mentioned before, oftentimes it seems like that hot stock tip, once we hear about it, majority of the money in it has already been made. Right. Unless that tip is a long-term growth strategy tip, which in some cases that may be valid, that you are looking at a stock or a company that has a long future and you want to think about that is the kind of investing that you want to do, is investing for a long time period, because then you can ride out those bumps, the ups and downs. You think about the individuals who invested in Bitcoin last week when it had a 10% drop in one day. And I don't know about you, but let's say you had taken $50,000 and you had thrown it into Bitcoin, and in one day you lost 10% of your portfolio. You went 50,000 to 45,000. A lot of people would freak out and pull out. Well, then the next day it was up like 9%. So that's the problem with hot stock tips, is oftentimes they're super volatile.
Yeah.
So we encourage,
it's a roller coaster.
Yeah, we encourage individuals to stay away from those hot stock tips, but look for that long-term investment.
Exactly. The next myth that we want to bust is that investing is complicated.
Right.
It sounds complicated, and I think a friend of ours said earlier today that it was created by rich white men, and maybe in that vein, it was made to seem complicated, but it ultimately is not that complicated. All you're simply doing, basically at a fundamental level, is buying a percentage investment in a publicly traded company, and with the hopes of that company growing in value or them issuing you dividends. Right. Beyond that, it's really not that complicated. You can do market analysis, and you can worry about all the different news alerts, and you can watch all the economic data. And while that's all interesting to us and valuable to know, it's not imperative to become an investor. And we'll talk about that later, about how you can actually invest much more easily than you might think that is possible today.
Right. Yeah, there are so many means out there in which the small individual, you and me, our net worth is relatively small compared to some of the big shots, that's for sure. But all of us have the capability of investing and growing our assets.
Exactly. So, what are the 5 tips to start investing? Number 1, the first tip is to understand who you are as an investor. And you'll find a suitability profile that we created on page 2 of the Super Simple Investing Guide that you can get at the link above. And what this does is it asks you 13 questions to get an understanding of who you are as an investor. What is your age? What is your what can you tolerate in terms of volatility, like David mentioned? Could you handle a $5,000 loss in one day? Or would you sell out, like he suggested? What are your long-term goals with investing? Do you have short-term goals that might subvert what your long-term goals are? And what those 13 questions will really do is help you figure out who you are as an investor, why you're investing, and ultimately come up with goals and strategy for investing.
Exactly. An example here is that John and I just pulled some money out of our condo. We are selling our condo, and we have a fairly large chunk of money that we're going to be getting. And so some people say, well, invest that. You've got a couple $100,000, invest that money. And so we have to think about, what is our goal? Do we need to use that money in the next 3, 6, maybe 6 months or a year. Well, if we do, we have to invest it differently than we would if we were going to say not need that money for 10 years. It's a very different way of looking at how we would invest that money because of our needs. And so that's what John is really getting at, is what is the goal for the money that you want to set aside? If it's long-term investing for retirement, you can treat that differently than if you're wanting that money to be able to buy, let's say, for example, buy a car in the next 6 months. Exactly. Treat that money completely differently.
Exactly. The second tip is to understand what's available to you and to invest in what's available to you based on your risk tolerance. And so what that means is, as we suggested earlier, Bitcoin is a volatile, risky investment right now. If you've only got $10,000 to invest to help you achieve what your financial goals are, that's probably not a wise investment for you, because at this point it's not regulated. We're not exactly sure what direction it's going to go, or if it's going to be around in a couple of years. Right. It could be around forever, but at this point we don't know. But what is more likely to be around are some large cap companies that you're already familiar with. Most companies that you can name off the tip of your tongue are companies that are typically medium or large cap and are great companies to consider investing in for the long term.
Right. But at the same time, you have to remember, what level of risk can you withstand? I think, for example, Snapchat. Its company, that company's parent had its IPO this year, and immediately within a couple of weeks started to dropped precipitously. About 30% of the value of that company was basically wiped out over a couple of months. So we have to remember, can you withstand that risk? Would you be able to say, okay, I'm going to ride it out? If not, maybe that's not the right kind of investment for you.
Exactly. And in this super simple investing guide, we spell that out. Did you include that pyramid that we created for the super simple investing guide?
Actually, I don't have that on here.
Okay.
Yeah.
Cool. Well, go ahead and check that out. As we mentioned, at the link above, you can get the super simple investing guide. It has a pyramid of different investments and how they rank in terms of risk. So you can figure out what investments might be most appropriate for you based on those 13 questions that are also in that super simple investing guide that you ask, but that you answer before you get to that.
Right.
Also, if you're watching this even after we're doing this live, please remember to like, comment, and share this so we can get this out to more people and help more people. And if you ask any questions, either now or later on, we'll be sure to answer those at some point now or in the future.
Yeah.
Okay. So what is the third step to start investing? The third step is to determine the right mix. Essentially, I love this picture because essentially what you're doing with creating an investment portfolio is creating a mix of investments that's appropriate for you. What your risk tolerance is, what your goals are, what your objectives are, what your time horizon is. When is it that you need to access this money? And basically, what you're doing is no different than baking. Is putting all of these pieces of the puzzle together, or pieces of all these different ingredients together to make what's most appropriate for you.
Right. So if you're going to bake a pie versus baking a loaf of bread, you know that you've got to have completely different ingredients, and that's really what this comes down to. So what are the kinds of things that you would use to determine what ingredients go into your pie?
Right. So one of the things what are your goals? Are you saving for a nearer-term goal, such as buying a house, or a longer-term goal as saving for retirement? Can you mentally tolerate a 5% drop in the market, or even a 25% drop in the market? That would determine how risky your portfolio can be, and the more risk you take on, the more potential reward there is. But of course, it's not always a guarantee, so you've got to weigh the pros and cons. And there are a number of different investor profiles out there. Right. We've broken these down into 3 fundamental profiles. This by no means is comprehensive, and you can do some research online to find different variations. But we've got a conservative profile here, and this particular pie, you'll see, is consisting mostly of bonds, mostly of fixed income investments. To reduce your volatility, you're investing principal to get a certain return back, and you're all but guaranteed to get that principal and that return back. Whereas with the large cap stock, the small cap stock, and especially the foreign stock that's also included in your portfolio, you may or may not get any of that money back. But the large cap and the small cap stocks aren't as risky as say foreign stocks or derivatives or Bitcoin or some of those more risky investments.
Right. Now this may be an area where it starts to get a little confusing or maybe a little scary because we're starting to use some terms that you're not comfortable with. So just think about this when we talk about conservative, moderate, and aggressive investing. It's basically on a continuum of how the risk level is and the potential reward. So the more the risk, the higher the risk, the higher the potential, the reward. The lower the risk, the lower the potential for reward, but the higher level of safety that you have. So that's what you kind of want to look at. It's very simple. It's just one straight line, super simple, easy, less risk, most likely lower return or less reward. And then there's the super high risk, high return, but potential for large loss. So you've got to think about that all in this continuum, one straight line from conservative, moderate, and aggressive.
Yeah, on page 3 of the investor guide, you'll see that there's a pyramid, and we kind of explain that with some arrows, the risk tolerance based on or the riskiness of various investments. Right. The next profile that we're going to show you is an asset allocation. Basically, all an asset allocation is the combination of your salad. Or the ingredients that go into your pie. This particular allocation is moderate, so you'll see there's a smaller amount of bonds in this portfolio. The conservative portfolio had 70%. This portfolio has 45%. And rather than having 10% in large cap, you'll see that in this portfolio there's 30% in large cap. So you're taking on slightly more risk, speaking to what David was talking about earlier. And then the last profile that we'll show you, and that's also included in the guide, is the aggressive portfolio. So this is the person who, and some people who have aggressive portfolios don't have any bonds in their portfolio, but that might be too aggressive for many people. But you'll see this particular pie, of the 3 that we show you, has the least percentage of bonds by 20%. A larger percent in large cap, and you'll see even larger in small cap and foreign stocks relative to what we had before. So you're taking on, like David said, more risk for the potential of more return, but you have not as much of a guarantee that you're going to get that return back that you expect.
Right.
So the benefit here, the more risky you are, the longer your time horizon is, the better you're capable you might be of achieving that goal.
Right. You can ride out those ups and downs in the market when you're a little bit more aggressive if you have a longer time period.
Right.
All right. So what about after you've determined this mix, you know what you want to have, what would be your next step, John?
The next step number 4, is to figure out what your budget is. A lot of you who reach out to us are paying off your debt. So once you've paid off your debt, you'll start accumulating cash. The idea here is to figure out, okay, how can I get that cash invested? But of course, you still need to make ends meet. You still need to buy groceries. You still need to pay your bills. So what can you set aside on a regular basis to start investing?
Right.
Well, in the Super Simple Investing Guide, we recommend a number of different brokerage firms that you can check out, all of which have low-cost commissions and no minimum balance requirements. So the benefit there is that you can start to set aside just a small amount. Can you set aside $50 a paycheck or $25 a paycheck, $200 a month? What works for you, and go ahead and figure out what that is and start to save up the cash so that you can put it into those accounts and then purchase the investments that you think are appropriate for you.
Right. Especially for some of you who are in your early 20s and you want to have $1 million by retirement. Did you know that if you got a 9% return, all you would need to invest is about $100 a month for 50 years, and you would retire with over $1 million. So we want to encourage you to think about how can you, what many advisors or financial services companies like to say, pay yourself first so that you can be ahead with your finances in the future. Paying yourself first means that you're setting aside that money to invest in yourself rather than spending it on other things that may be for the here and now.
Exactly.
All right.
And then step number 5 is, like I just alluded, is open an account. And in the Super Simple Investing Guide, we include a number of brokerage firms to check out. Of course, that by no means is comprehensive. So do a search online for low cost or free investment accounts. But you want to make sure that you open an investment account that's with a somewhat reputable firm, so that you don't risk losing your money. But go ahead and start opening that account. We've outlined in the Super Simple Investing Guide how to proceed with opening an account and what to do once you go ahead and start investing.
Right. And as that picture showed, it showed a robot. So there's a lot of talk out there right now about robo-advisors, which is a kind of automated way. A lot of companies are using this artificial intelligence as a way to figure out how to determine what your pieces of the pie should be made up with. So as we talked about conservative, moderate, and aggressive, well, basically what they're using is computer systems that will ask you some questions to determine, are you moderate? Are you conservative? Are you aggressive? And then based on those, which stocks or bonds or mutual funds or ETFs, whatever investments would be best for you to put into your pie. And they're doing that for you. So there are some fees associated with those oftentimes, but it allows you to have some expert advice behind making your investment choices. So we would encourage you to take a look at those, but also exercise caution because, again, it's important for you to understand what you're being invested in.
Exactly. And some of the companies that specialize with robo-advisors are Wealthfront. You can find them by Googling their name, Wealthfront, and then there's also Betterment, which you can Google them as well. And they're one of the leaders in the robo-advisor space. So if even after you listen to this and you read our article from last Monday and you download the Super Simple Investing Guide, you still don't feel comfortable investing on your own, consider maybe one of those robo-advisors. They might be able to help you out.
Yeah, and we just got a shout out here from Wendy Garfunkel.
Hey, Wendy.
Wendy is with diy.fund, which is a platform that's going to be coming live here very soon. You want to check that out. We had a podcast this week about diy.fund. You can check that out at queer.money or podcast.debtfreeguys.com.
Exactly.
And you can
We talk a little bit about investing on that podcast as well.
Exactly. And it was great because Wendy and her husband Eric have started a platform that is really trying to help make investing for the novice investor or the smaller investor much easier and allows us to invest a little bit better like pros.
Exactly. They're creating a pretty awesome dashboard that will make even the most novice investor feel like a professional. So look out for more of that coming soon.
Exactly.
So thank you for joining us for another Debt-Free Guys Live. As we said earlier, please click on the link above to get the Super Simple Investing Guide. Don't forget to join us next Wednesday at 7 p.m. Mountain Time, 9 p.m. Eastern Time for another Debt-Free Guys Live where we're going to talk about how to retire early. There's a whole movement in the personal finance space called FIRE. Financial Independence, Retire Early, and all of next week we'll be talking about ways to prepare to retire early, including our article from Monday as well as our podcast with guests who are the hosts of the Fire Drill podcast. Right. They're coming on Queer Money to talk about their strategy for retiring early.
Right.
And you don't want to miss our retire early checklist.
Right.
That'll help you achieve the same goal as well.
So remember to check us out here next week. Just use the information below. We also post on the Debt Free Guys Facebook page a notice, so you can click on that to get a reminder when we do our Facebook Live.
Exactly. And after you have a chance to look through the Super Simple Investing Guide, if you have any questions, comments, suggestions, please join us in the Queer Money Facebook group. It's a private group where we're helping LGBT people become fabulous, not fabulously broke.
Exactly.
So join us there. Thanks a lot.
Cheers. Thanks again. And all the best to a financially strong queer community. Thank you.